Hey, it's Dan Morales. This is Home Buyer Radio. I'm not really sure what episode number I'm on because I lost track. But I've been doing a series on credit and talking about how important credit obviously is as part of the mortgage process. And so I wanted to bring on my friend and special guest, Sam Parker from My Credit Guy. Sam, welcome to the podcast.
Hey, Dan, I appreciate you having me. Thanks a lot for having me on here. And, I look forward to it.
Yeah. So, you're the expert when it comes to credit, right? I always tell people I know enough to be dangerous, but when you start going down this road of more complex situations people can have, you really, oftentimes need somebody who is an expert that deals with this stuff day in and day out. Because I kind of feel like the whole credit, system is like a moving target sometimes. I mean, would that be a fair, fair thing to say?
Well, it's definitely not consumer friendly, meaning, the credit bureaus put up this big front and they put money behind it to market it to clients about how easy it is to fix your credit if there's an error or to keep up with it. And it's just not true. There's so many ins and outs that the consumers just don't know about. Even, as blatant as how the credit scoring algorithm itself works is just kind of counterintuitive a lot of times. So a client using their rational thinking might be taking actions that are costing them points in some cases, So,
yeah. That's funny because you hit on a topic right away, right? Like a lot of times, I always tell people you cannot apply logic and common sense to this process because oftentimes what you would think is logical and is common sense could actually be something that hurts you, right? Like going in and paying a bunch of collections and stuff like that, prematurely. Could end up, you think, oh, okay, great, I paid it off. Can you talk a little bit about what, collections, right? Like we just did that, talking about that, but, where are the areas where people get most tripped up when it comes to like collection accounts and stuff like that?
Yeah, so this one is a little bit of a rabbit hole, Dan. I could talk for a while on this. So honestly, I need to back up a second to give a good answer. So first of all, people get confused between what's a collection, what's a charge-off, what's a profit and loss. And those are all three collection actions on your credit report. They kind of fall into the same category of you didn't pay somebody and they want their money. The difference between a charge-off and a profit and loss, and I can circle back to what those actually are and what they mean, but a collection has been sold to a third-party company that's now trying to collect on behalf of the original creditor. And what that means is you actually get protected a little bit with a collection because it's no longer factoring into what's called your balance to limit ratio since it's been sold to a third party company. If it's still held by the original company, then you're getting hit for, like, say it's a credit card. You could have a maxed out credit card that's also technically like a collection. But with a collection, it's been sold to a third party. They're trying to collect on behalf of the original creditor, or more than likely on behalf of themselves now because it's been sold. And the dollar amount doesn't matter anymore, which means if I had a $1 collection on my credit report and I had a $5,000 collection on my credit report, depending on how old they are, the $1 collection could be hurting me more than the $5,000 collection. So what a lot of people do is they'll look at their credit report and they'll see collection. A lot of times people have a bunch of medicals on there, right? They went through a bad time, or, one hospital visit left them with 8 medical collections. So those are from 5 years ago. They can't get a home loan. They think right away, well, I know what I need to do. I'm going to go pay all these little medical collections off. It's going to jump my scores up. Unfortunately, what happens is that basically refreshes that account. It updates what's called the date of last activity, and it brings it to the current date. So basically what you just did was added 7 collections to your credit report, even though they're zeroed out. Remember, with a collection, the dollar amount doesn't matter anymore. So it could be $1, could be $5,000, could be $0. And what really impacts your credit scores are the date of last activity and what's called the MOP rating, which is another one of those things, information that you won't even be able to find on a consumer report. So it's being held against you, yet you can't see it. So I know that I didn't really just clarify anything for the common consumer, except for when you pay a collection, it'll actually drop your credit scores. It's not fair. I'm sorry, but there are reasons why.
Exactly. Well, that really is the best answer, because a lot of times people think like, okay, I'll go ahead and pay it, like you said, not realizing that when you did that, you reset the clock, if you will, 7 new collections show up, and now all of a sudden you could have just shot yourself in the foot. So a lot of times I'll tell clients, if you have a collection account, leave it be until we tell you to do something with it, right? Until you advise them to do something with it, or they're advised, from their lender to do something with it. Don't touch it, right? Because you could actually shoot yourself in the foot, not knowing that you're shooting yourself in the foot. And again, you kind of hit on really a good segue into the next thing, right? Like, so a lot of times people will get these consumer-based reports, right? Whether it's, Credit Karma or somebody like that. And a lot of times people will come in with, oh, my Credit Karma score is 700, and then they're shocked to find out their mortgage score is totally different from it, right? So can you talk to, like, I've talked about that a little bit, but, those differences in the types of reports and what they mean to the client?
Yeah, well, first of all, in general, there's two different types of reports. There's reports that are generated for financing, like you're going for a mortgage, a car loan, a personal loan, whatever. And then you also have consumer scores, which are the ones where you go online, you go to whatever, Karma or credit whatever.com, and you pull a consumer score. So you have a couple different factors going on. First of all, there's two different scoring models altogether, or think of them as like two different companies. You have FICO, which is, in my opinion, the end all be all. That's what most banks go by. And then you have Vantage scores. So not only are there two different scoring algorithms or companies altogether, but then within that, FICO has dozens of different models that are used to calculate different things for different industries, because the auto industry qualifies their clients differently than the mortgage industry. There's different things in the same credit report that they're going to place more or less importance on. And so you're going to have different credit scores from place to place to place to place, especially when you cross that line of consumer to banking, because not only are you probably going from FICO to Vantage, but you're using some random Vantage model. So what happens is you go online, you get confused, because let's say a website, and you and I both know the worst one out there when it comes to scores being bad. But let's say you go to that site and you pull your credit and it pulls a 700 consumer score. What it's going to be doing is advertising things to you off on the side that if you had a real 700 credit score, you would qualify for. You click on those things. Now your another credit score is pulled, because they're not going to use that garbage consumer score. So now they offered you something based on your fake score. Now and then when you don't qualify for that, they're downgrading you to what your real score is. So all of a sudden you thought you had a 700 credit score, but you're qualifying for a credit card for somebody with a 620. And then you've just been caught up into this funnel. So you just got to, at the end of the day, a lender's credit score is all that really matters, because that is your biggest purchase. That is where your family's going to lay their heads. Pay attention to lender score. The other stuff is just information, really.
Yeah, and it's I always tell people, I get this question all the time. Such and such said my score was this, or I get a free credit score from my credit card. And I always tell people, the two, they're not the same. Right. And oftentimes it seems like those credit scores that a client gets on a consumer-based site tend to be things that are they're higher.
They're high. Yep.
Than what ours would be. And then, they're disappointed to find out that our score is so different. And, unfortunately, in the mortgage world, I've got to work off my score. I can't use the other score. And, they're just two different models.
Right. You'd love to. You'd love to. It's not your fault.
Man, I'd make a lot more loans if I could use the other one, right?
Oh, my gosh. Yeah.
So what would you say is the area that, where most people have the biggest impact on FICO? Is it collections? Is it credit utilization?
Honestly, the consistent thing that I see is that plagues almost everybody is credit utilization, because whether you have a 700 credit score and you really should have a 760, or if you have a 600 credit score and you should have a 660, almost everybody, whether you have good credit or bad credit technically in terms of negatives on the account, there's so many people out there that are maxing out their credit cards or overutilizing their credit lines that I would say that's the most widespread problem across everybody. Is you might be a millionaire, you probably have some maxed out credit cards on your account, because it's the American way. You spend a certain amount, you make a certain amount, you spend either just under that or or over that, So credit utilization, even though it only makes up 30% of the score, where pay history makes up 35%. But I would say in terms of overall effect on people, that credit utilization is probably the
biggest piece.
Yeah.
Yeah. And that's what would you say is the sweet spot? I know for credit utilization, because I usually will tell folks the fastest way to pick up some points on your score is to pay down your credit card balances, right?
Absolutely.
The rule of thumb is to be, at least get it less than 50%, and then, even ideally less than that if you can. Where's really that sweet spot? Is it, 30%, 25, 35, 50? What would you say in your experience you've seen as kind of a sweet spot there?
So kind of what you were saying, there's a we'll at least get it here, and then if possible get it here, and then if ideal, in an ideal world, get it here. And those marks are, you got to have it under 50%. When you're going to get financing, you have to make sure your credit cards are below 50% of the balance limit ratio at least. Otherwise, you run a risk of that credit card or that account, that revolving account, hurting you more than it's even helping you when it comes to credit, because the credit utilization or overutilization will outweigh the pay history or the fact that it's an open positive account. So get it below 50 at minimum. Where you start to get actual like bonus points for it or reward points, whatever, where it's really working for you, is below 30%. And then in a perfect world, we want you to hover between 5 and 10%, because it's a damned if you do, damned if you don't algorithm, where if you're not using your credit for a long time, like you have your JC Penney's card that you're like, I haven't used that in 8 months. It's not helping you anymore. After usually about 6 months of inactivity, that thing's might as well not be on your report for the most part. So you want to use it, but you don't want to zero it out, because the other thing to keep in mind is that credit is taken in snapshots, meaning if they pull your credit today, they take a snapshot of it today. If it's at $0 and the last time they took a snapshot, it was at $0, you might not even get credit for the responsible utilization that you've had in the last 30 days. And so you want to keep that nice low balance to where in the grand scheme of things, you're paying them like $2 a month in interest, who cares? But you're working the system, you're playing the credit game so that your scores can be 40 points higher, so that your rate can be, a half a point lower, so that you can save $100,000 over the course of your 30-year loan. It's just, you got to know the rules of the game.
It's funny because I've seen that, in my own personally, right? Trying to, I don't want to say manipulate the system, but, if you pay everything to zero, it actually can count against you.
Yeah.
We just worked with a client here recently where we were able to get them pick up a 0.5% rate by paying down some credit cards. But I told them, like, you cannot pay this account down to zero, because if you do that, it actually hurts my score more than if you left $100 on it.
Yeah,
so
isn't that crazy?
Down and leave $100 on it, and I actually, 15 points up than if you pay it to zero. Which again, it goes back to what we talked about originally. It goes against kind of conventional wisdom, right? I should normally pay this thing to zero. I didn't pay it to zero, and somehow my score is higher. It goes against that conventional wisdom that people have sometimes. So that's a good piece. Talk about inquiries a little bit. I get this a lot. People, I don't want another inquiry on my credit report and this, this and that. But, they're so concerned about inquiries. When you look at that algorithm and the math, really how important are inquiries and what big of an impact do they really have on score? What do you see?
Yeah, that's a great question with a lot of common misconception. One thing I want to really quick circle back on paying the credit cards down. If there's anybody out there that's listening to this that's like, I'll do you one better, I'm going to pay the thing off and close it, that is the worst thing that you could do. You will crush your credit score. So don't close accounts either. Don't pay them down all the way to zero, and definitely don't close them. Talk to Dan or myself first, okay? But in terms of inquiries, this is like the scapegoat for credit. It's where if you don't want to take credit for or responsibility for what's actually going on in your credit, blame the car dealership for adding 5 inquiries when you thought they were only going to add 1. And I don't say that to be harsh. I just say it to be brutally honest, I guess, is that an inquiry is not that big of a deal. And depending on what industry you're having credit pulled in, you could have 5 inquiries, you could go to a car lot and in the same 30-day period have 5 inquiries and they would only count as 1 because they're in the same industry. You get anywhere from 30 to 45 days. The credit bureaus are wishy-washy on saying what it actually is. So I just say, hey, be careful, go with a worst case scenario of 30 days. But even if, like, let's say that I went to Dan today and I said, Dan, I want you to pull my credit, or I want to get qualified for a home loan. Normally, here's the way this conversation goes, Dan, is you go, okay, cool, I would love to qualify you for hundreds of thousands of dollars. I'm going to need to take a look at your credit. And then I, as the consumer, go, oh my gosh, don't pull my credit. I had it pulled a month ago, and if you pull it, then you won't be able to, then my credit score will be bad. And you're sitting there like, well, I have to look at your credit because remember, you want several $100,000, so I need to see it. And they're like, well, you don't even need to. I'll tell you what it is. It's 720. I just pulled it off Credit Karma. I'll just ship that on over to you. And it just, the bottom line is it doesn't work like that, folks. Dan needs to pull credit because you are asking him for somebody else's money, hundreds of thousands of dollars of somebody else's money. They need to pull a credit report that they acknowledge and see what they can do. Credit score wise, it's going to cost you between 0 and 3 points as a worst case scenario. In a worst case scenario, 2-3 points. So in the grand scheme of things, it's nothing. It's necessary. And his report is not the same as Credit Karma, and there's nothing he can do about it. So just let him pull credit and quit being weird about it, and then focus on the things that you really are missing out on, maybe, that are hurting your credit. Your maxed out credit cards, your collections, your charge-offs, your profit and loss, your late pays, things like that. But looking for inquiries, unless you already have a super clean credit report and you're in the mid to upper 700s, it's more than likely not inquiries that are a major factor on your credit report.
Yeah, good. Well, and that's such a great answer, because I get that a lot. Well, I don't want you to pull my credit report. Well, now I tell people it's like a doctor trying to give you a diagnosis without being able to see you.
Exactly. And they're like, I'll send you a picture of it. And you're like, no, I need an X-ray, not a picture. And I mean, it's the same thing, like if you want a doctor to fix your broken bone, you got to look at an inside picture called an X-ray, not a snapshot called Credit Karma.
Yeah, exactly. Well, we partnered with you and your team, and in what we like to call credit repair. I kind of, you're like a credit consultant, really. Like you're helping to consult people through, because all these moving pieces that help them to get to the most optimal outcome when it comes to the mortgage process and mortgage world. Maybe talk a little bit about what you guys do and kind of what your process is and how you work with clients.
Sure. Yeah. Well, when we built this thing, we just wanted to be different in the sense that credit repair, it was crazy, just an entire industry having a bad reputation. And you look at it, you're like, okay, well, let's take a poll. Like, why do consumers and lenders alike hate credit repair? Well, they charge up front. That's against federal law, so we don't do that. They overpromise and underdeliver, so we don't do that. We're conservative and realistic in our expectations. They're not honest with the clients. They tell them that they can wave a magic wand and everything will be gone. That doesn't happen. Then the clients get mad. Okay, let's not do that. And then communication sucks. You send a client over to somebody, or you enroll with credit repair, and for 30, 45, sometimes 60 days at a time, you're just waving in the wind, not sure what's going on. So what we did when we started was we said, look, if we're going to people who are trying to get qualified for home loans, or going to lenders and saying, hey, listen, we have a system in place. Let's really have a system in place. Let's make sure that we can actually get people back to the closing table. So from the ground up, that's the way we built our process, where when a client comes into the service, we're figuring out not can we repair your credit or not, but what is it that's holding you back from qualifying for a home loan with Dan Morales, right? And so that's what we built. So what we do is we start off by addressing the things that the clients disagree with. But first, we figure out what they disagree with and why, rather than most credit repair companies just like, oh, you have 10 negative items on your credit report. We're going to hit every single one of them and make a mess of the credit. When in reality, only 6 of those items might have really been having any real significance on the credit report, and the client needs to take accountability for some things. So what we'll do is we'll address the negatives and we'll get the credit as clean as it can possibly be. We'll make sure that it's accurate to start with, meaning we're going to get, outdated, duplicated, inaccurate items removed or updated. Then what we do that's pretty unique to our industry is that we switch gears and we start helping clients out with settlements and pay for deletions in terms of the negative items that remained on the credit report after our challenges or our verifications. Yeah. Most credit repair companies will just dispute it over and over and over and over again. And while initially that sounds good to the client because they're not having to pay out hundreds or possibly thousands of dollars to make good on the validated debts, you're not getting you or your family into a home loan. And that's the goal here, right? And that's who we're dealing with. We're not for everybody. If all you wanted was a magic wand and jump your scores up a little bit, we're not the company for you. But what we will do is handhold you back to the closing table with Dan. So we do the correction. We move on to settlements and pay for deletions, where we will help our clients negotiate their validated debts down, save them hundreds or thousands of dollars in that process. We will look at their positive trade lines, like how we talked about credit cards. Some people don't even have credit cards working for them on their credit report. So we'll help them get new positive trade lines opened up. We'll teach them how to use them correctly. If they already have them on there, we'll just do some coaching on exactly what dollar amount to pay them down to by what date. And then that whole process put together usually gets clients in, fixed up, and back out to the closing table in 2 to 4 months, where with other credit repair companies, you're with them for 6 to 12 months and most likely either give up or get to a point where your loan officer has to take back over to try to sort things out and get you qualified for a home loan. So we've just built it from the ground up to actually get you and your borrowers, back to the closing table, man.
And I appreciate that because I know, having worked with you guys, that you guys do those things. And in my 29 years as a mortgage banker, I would agree with what you said originally. It's like, why do, a lot of lenders just hate credit repair type of stuff, because oftentimes it's broken promises. It's everything that you spelled out is what happens, right? That's the stuff that we see happen time and time again. It never plays out like you would hope. And ultimately, when you make a connection, with a client to somebody like you guys, you want that desired outcome. You want somebody to be able to help guide them through this process of, getting things corrected and fixed, settling things that need to be settled, and oftentimes working towards reestablishing credit as well too. And that's an area where those areas where there's these different creditors that play really well with reestablishing credit, reporting, and so on. What's one of the quickest ways for somebody to reestablish credit? Because we run into that a lot. Like, hey, I've had negative credit, nobody wants to give me any credit. How do I go about getting some form of new credit if my credit was jacked and I keep getting turned down?
Yeah, we actually were lucky enough to kind of help in the creation of this credit card. We don't own it or anything. We are just one of their first kind of guinea pigs, and they knocked it out of the park for us. But it's called the Credit Builder Card, and it's a $200 secured card, reports to all 3 credit bureaus, usually within 2 to 3 weeks. So it's kind of a low threshold for risk. You're putting up $200, but then you're basically guaranteed that credit line. There are some people that get denied, but it's very rare, and there's always a good reason why. But anyway, it's this $200 secured card, reports to all 3 credit bureaus. And it reports very quickly. So you can go from a no score to generating a score. I would normally suggest getting 2 of those, or getting at least 2 credit cards opened up at the same time. One alone, if you're going from 0 trade lines, usually isn't going to actually generate that score. You want 2 trade lines so that scoring algorithm picks up on it and gives you a nice, healthy middle score.
Is there a length of time that those have to be up there? So let's just say somebody applies and they get 2 secured accounts. Is there a certain length of time before you see a score is produced? Or
normally with credit cards, you're looking at 60 to 90 days. With this Credit Builder Card, we consistently see those scores appearing in, I don't like to say 2 weeks, because that's if everything goes really well, but in 3 to 4 weeks, this thing looks like a charm. It's on there, and it's we've used it for thousands of clients, and again, we don't have any ownership in it. I don't have a dog in the fight. Just shout out to the Credit Builder Card and Bill Butler over there. They've really built a great tool that goes hand in hand with what we're trying to do to, get clients to really take responsibility and to take control of their credit going forward, so that not only do they qualify for this loan right now with you, Dan, but the next time rates drop, you give them a quick call, let's do a refi, and they're like, yeah, with my 740 score, let's do that refi, Dan, you know, so.
Well, and it impacts people in so many different ways that they don't even realize. You know, there's so many different ways where credit is used. By going through and making an investment in time, energy, and a small investment in yourself, you have an opportunity to really kind of reset a lot of things. And, you know, there's a lot of stuff that's reported, you know, erroneously. You know, so this is, you know, for those folks, it's a great reset, you know, but, you know, as a lender, you know, I know enough to be dangerous. I don't have the time to work on somebody's file like that, right? You know, and so, you know, they need somebody who's an expert. They need to be willing to invest in time and energy and working with somebody like you who knows what they're doing, that can guide them through that entire process, kind of from start to finish, get them where they need to be. So how does somebody get in touch with you guys?
Yeah, so you can always just go to our website, mycreditguy.com, and set up a time for a free review. You can email me, sam@mycreditguy.com, or you can always get a hold of us, 866-726-7339. Or if you want to find me on Facebook, you can always message me as well. So any which way that that works for you. We know that everybody has their own little comfort level with whether it's a phone call, a text, or a message, and we will accommodate you every which way.
Yep. Awesome. Well, my name is Dan Morales from North Point Bank. My NMLS number is 709-729. You can find me online at danmorales.com, DANMORALES.com. Phone number is 616-931-4629. And of course, North Point Bank is an equal housing lender. But Sam, I just want to say thank you. I really appreciate you taking the time. I know you're a busy guy, just sharing your knowledge and expertise. And as a lender who's been doing this for a long time, I can tell you guys who are listening to the podcast, I've seen a lot of people in that industry come and go, but you are the only guy that I actually feel comfortable in referring clients to, that I know you'll do what you say you're going to do, and you guys run a first-class organization. So thank you for taking some time with me today, sharing your wisdom and expertise. And again, if somebody's listening, we've got listeners all throughout the country, this is something that you could use some assistance with. I can't encourage you guys enough to reach out to Sam and his team. All right. Thanks for listening, and thanks for being on the podcast, my friend.
Thank you, Dan. I really appreciate your time.
All right. Appreciate it, my man.